Now that we know the rules of debit and credit, we are going to use those rules of debit and credit to record transactions in a formal manner. So let's take a look at what we do with a transaction. So the first thing we do is we analyze the transaction through source documents. Source documents tell us about the fact that a transaction has taken place. So examples of source documents are invoices, bills, some type of a purchase order, things like that. So from those source documents, we know that a transaction has taken place. And so the first place that transaction will get recorded is in a journal. From the journal, the transaction then gets posted to the ledger. And once all transactions are posted to the ledger and account balances have been determined, we prepare a trial balance. Now, these are the first 4 steps from the accounting cycle that we will see in detail in Chapter 3. So graphically, here's what's going on. We analyze the source document and find out that the transaction has taken place. Then we use the rules of debit and credit to journalize the transaction. And once the transaction is journalized, we post it to the ledger. So let's say that we had an event where the owner invests $30,000 cash in exchange of common stock. So the first thing we do is we analyze the situation and say, okay, which 2 accounts were affected? And the answer to that question would be cash and common stock. And we know then that cash has increased for the business and common stock has increased as well because shares of common stock were issued. So applying the rules of debit and credit, then we would say that since cash has increased, cash needs to be debited, and since common stock has increased, common stock being an equity account, it needs to be credited. So we are going to prepare this journal entry which shows a debit to cash and a credit to common stock. So here is an example of the general journal. So in this general journal, to record this event, we first record the date of the transaction, whatever it be, and then we record the titles of the accounts affected. So in this case, the 2 accounts affected were cash and common stock. And we debited cash, so we record the debit close to the margin, and we credited common stock, so we record that credit slightly away from the margin. And typically the account debited is always written before the account credited. And then we record the dollar amounts by which these accounts were affected, which is 30,000. Cash was debited, so we put 30,000 in the debit column. Common stock was credited, so we put the 30,000 in the credit column. And then we have a transaction explanation that tells us what this journal entry was all about. As far as we are concerned, we are going to omit this transaction explanation because I give you a list of the transactions. So it would be repetitive to write it out again. A business doesn't get a list of transactions. They use source documents to know a transaction took place. So once this journal entry is prepared, then the next thing to do is post that journal entry to the ledger. So we are first going to post it to the cash account, and then we are going to post it to the common stock account. So we find the cash account in the ledger. Remember, a ledger is a place where we have all the accounts that a business has. It's a complete collection of all the accounts. So we find the cash account, and the first thing we're going to do is we are going to record the date from the journal entry. And the cash account will include all the times where cash was affected. So we're not going to rewrite the journal entry, but we're simply going to record the information about cash. So we have debited cash for 30,000. So we are going to record it as on the debit side. Okay. And there are 2 columns here, one for debit and one for credit. So each time cash is either debited or credited, we would record it in one of these columns. Next, what we do is we want to know that we have posted this journal entry into the ledger. And so the column PR stands for post reference. So we are going to record the page number of the journal where we got that entry from. And G1 stands for page 1 of the general journal. And then we're going to determine the balance of the account. So now, since there were no other entries in the cash account, the balance of the cash account is 30,000. But had there been a previous debit of 10,000 in this account, then the balance of this account would be 40,000. Now, since we have finished the posting to the cash account, the post reference column in the journal will contain the account number of the account where we posted that entry to. So account number 101 relates to the cash account, and so in the post reference column of the general journal, we record the account number where we posted this journal entry. Likewise, we are going to find the common stock account and post it as a credit to the common stock account. So the common stock account in the ledger was account 307, and we posted the 30,000 as a credit to the common stock account and determined the balance, and in the exact same process we did with the cash account. Once all the transactions have been journalized and posted to the ledger and account balances have been determined, we prepare a trial balance. So a trial balance is prepared to make sure that the debits equal the credits. So what we follow is the double entry system of accounting, where for every debit there is going to be a corresponding account that is credited. And so to ensure that we have gone through the posting process correctly and that debits equal credits, we prepare a trial balance. In the trial balance, we list all the accounts in the ledger along with their appropriate balances, either debit or credit. And then once we do that, we total the columns to ensure that the balance is equal. A trial balance can also be used to prepare financial statements because we have all the accounts in one place. So we will use the asset, liability, and equity accounts to prepare a balance sheet. We will use revenue and expense accounts to prepare an income statement. Sometimes there can be errors in a trial balance. Your trial balance columns may not equal. And so how do we find out the errors? In that case, we literally retrace the steps to figure out where the error occurred. We first total up the columns one more time, then we go back to the postings, then we go back to the journal. So we retrace our steps. And there might be some events where the totals of the trial balance equal, but still the trial balance is not correct because we may have posted a credit as a credit, but to the wrong account. And so your trial balance totals will still equal out. However, the account balances within the trial balance will not be the same. So those types of errors are very hard to find. So now I want you to do is, I want you to see the video where I have solved a problem where we have a list of several transactions that we've journalized, posted, and prepared a trial balance with. It's a very complete problem, and it's I must caution you, a very, very long video. So you may want to pause and then watch it again. But the reason it's this long is we followed the transactions right from the time of journalizing to posting and then preparing a trial balance. And I must tell you that we are going to substitute ledger accounts with T accounts. Ledger accounts are very cumbersome to draw out, and so we're going to substitute ledger accounts with T accounts. They're essentially the same thing. They have a debit side and a credit side, but they're just easier to prepare. So as you watch the problem solving, you will notice that we have used T accounts and not ledger accounts. So this is a very important chapter. This wraps up chapter 2, and I hope you understand every bit of this chapter, because once again, this is one of the most important chapters in this course.